A new report from Equifax shows an increasing number of Canadians are missing loan payments as they also rack up more debt. For more, let's bring in Rebecca Oakes, VP of Advanced Analytics at Equifax Canada. Rebecca, thanks so much for your time today.
Thank you for having me.
So walk us through what you're seeing in terms of Canadians' debt levels right now.
Well, I think if we start with the mortgage side, unsurprisingly, we're starting to see that slow down a little bit in terms of growth. That has been increasing for several quarters, and it is now, obviously, because of the housing market slowing down. When we look at non-mortgage debt, on the other hand, we have seen that increasing over recent quarters. Q1 dropped a little bit, but normally we would expect a much bigger drop than we've actually seen. So it's actually up compared to where we would normally expect it to be, and that's primarily due to credit card balances, which have now reached around $102 billion. On the missed payment side, we are unfortunately seeing more people starting to miss payments. Good news is that it's isolated to a degree. It's in pockets of consumers as opposed to being very widespread yet, but it is definitely picking up pace.
And where, who are you seeing that are using credit cards more or what have you in terms of demographic-wise, Rebecca?
It is across the board, but in particular, we are seeing millennials, so kind of 35, 45-year-olds are using it more and more. Younger consumers have also been spending more on their credit cards. So it is everywhere, but tends to be a little bit more in kind of the younger side rather than the older generations.
And when it comes to those missed payments, what are you seeing there?
Well, on those, we are seeing it across pretty much everywhere again, unfortunately. When we look back to Q4, we saw that primarily on lower income, younger consumers, and it tended to be on consumers that didn't have a mortgage. The shift we're seeing in Q1 is we are now seeing that move more into consumers that have a mortgage. And some of that we do believe is down to things like payment shocks, as some of those mortgages are coming up for renewal and they're having to take on a higher interest rate, unfortunately.
When it comes to bankruptcies or delinquencies, what are you seeing on that front?
Well, when we look at the insolvency side, it's kind of two parts to it. We have the bankruptcies, the full bankruptcies, which have been low and actually quite flat since the start of the pandemic. Consumer proposals, on the other hand, they have been steadily increasing. Those levels are now above pre-pandemic levels. And in particular for Q1, again, we're seeing a bit like delinquency, more of a growth in terms of consumers with a mortgage. And in particular, what we are seeing is a higher percentage of consumers where there is no pre-warning that they are going to go insolvent. They're not missing payments, they just suddenly become insolvent. So a few things for kind of lenders to be looking out for there.
What do you think would lead to a situation like that where things seem okay and then not?
I think it's probably just a reality of, sometimes consumers are more aware of the options that are out there nowadays. So consumer proposals, they're a bit more out in the advertisement space. So I think if they're looking at their finances, they know that this is going to happen. I think that is our advice right now for consumers. If you have a mortgage that's coming up for renewal, start thinking about how are you going to manage it through that period, because payments may go up and potentially they may be just looking at those options before they actually reach that point.